another. It is October the 5th. And as we said, we're going every other week from now on. We're going deeper with our community. We're providing more information about actually what you could be doing in the market and research to help you make more money versus research for the sake of research. And we're also looking at new investments that are both international and domestic for the IA members who invest together. And that would be the IAA Portfolio Panthers. So with that being said, today we're talking about how the fourth quarter through the second quarter of next year typically tend to have higher return on investments than any other time in the market. Now, while Leon tells you why we chose that topic, I'm going to do my housekeeping.
Yeah, so this topic is, I think, a little timely because one, we're going into the fourth quarter, and two, everyone just needs a little hope in this market. Just something to hang your hat on. I mean, we're down at the worst 25 for the S&P 500, which is generally the market, down 25% this year. Tech stocks, the Nasdaq, was down closer to 35%. I would say conservatively, most people's portfolios so far this year are down a minimum of 20%. My personal portfolio is down. The worst it was down this year was 35, close to 40%. It's come down.
You know me. So I think at the worst, I might have been down close to 57%.
Yeah, because you're definitely more risky.
I was tech heavy.
Yeah, I was too.
And I had what's called single stock risk. So for
we know about you good old Tesla.
So for anybody who doesn't know, single stock risk is when you're either solely in one stock or overly weighted, meaning most of your portfolio is in one stock. If you're basically at the whim of that stock. So I had single stock risk. I saw like a 57% drop because my biggest position was Tesla, and Tesla is fickle, like and always volatile, very well. Yes. Yeah. So, but now I'm not looking so bad. So, yeah.
Yeah, so I was down like 45% at my worst. Since I've been paring my portfolio, cutting things back, adding things in, doing more healthcare, cutting a lot of tech. Now I'm down, I don't know, between 30 and 35% so far for the year, which I take as a win because I'm down kind of on par with where the NASDAQ is, which is mostly tech heavy. As Brent said, if you were super tech heavy, you could be down, 40, 50, 60% or more. So I mean, I'm actually feeling pretty good where I am right now, being down, let's say 30% for the year.
Now, real quick, let me say this too. For me, when I was down at that 57 mark, luckily I had the therapy of Investing Education Academy. And sometimes you guys probably don't know this, but Leon and I have to counsel each other on different things when the market gets crazy. We are not immune to the craziness. And so I say that to say, I was able to have a talk with Leon, and I increased my position instead of running away from it. And when the stock rebound, I did very well. So, in the grand scheme of it all, it worked out.
Having that support system or support group. And to that point, so this weekend we had our meeting. We have our monthly meeting with the Portfolio Panthers. That's a group of us who invest together. Some of them went in with us on the property in Ghana. One of the members, Nick, he made the point, and he always says this. He's like, sometimes it's like a therapy session, right? Sometimes it's just good to hear that other people are struggling in the market like you are, and that's a valid point. When we had our meeting with the Portfolio Panthers this weekend, it was therapeutic for Nick to hear, where the market is, where Brent and I are, where even some of the big hedge funds and pension fund manager are. Everyone is down, right? It's like everyone is down. Everyone is hurting. It felt, Nick is down too, like everybody else, but it felt good for him to hear that, okay, he's not alone. He's not just him out here floundering in the market. No, all of us are down. So again, it's good to have that community, just kind of, ping ideas off of, or just even talk to her, just, again, like a therapy session, just to hear that, other people are doing, again, it's not just you. It's not just you. It's not just Nick. It's not just me. It's not just Brent. All of us are down. So the reason why this topic is important is because we want to start off the fourth quarter, which starts now in October, last 2 months of the year, on a positive note. So, and Brent, if you could pull up the slide when you get a second. So some people may have heard, Brent and I've talked about this before. There's something that's called the Santa Claus Rally that typically happens at the end of each year. The Santa Claus Rally is defined by Brent, could you zoom out one? Yeah, so that, yeah, there you go. Santa Claus Rally is defined by the last, sorry, is defined by Christmas through the end of the year. And typically during the Santa Claus Rally, the stock market rallies about 1.5%. Again, that's typically, we don't know what's coming this year, but that this just is like on average or typically. And then typically, or on average in the fourth quarter of each year, the stock market in general rallies about 4%. So that, and that 1.5% is included in that 4%. So, so theoretically, before Christmas, we could look for around 3% rally, and then we get that, or 3% rally, and then we get the Santa Claus rally, which is about 1.5%. So it's that to say the fourth quarter typically is the best quarter of the year, and of course, again, the Santa Claus rally, Christmas shopping. This is where retailers actually legitimately make most of their money in the last 3 quarters of the year during Christmas season. So that's for retailers. So that's one subset of what we want to talk about today. So what we have on the screen here is a slide put up by Ally Invest, and it's titled "The Happiest Time of the Year for the stock for stocks for stocks start in November," and that's why we want to start off on a happy note. And what it shows is, and this was actually kind of surprising to me, is that typically from May through October of any given year, the stock market is up on average anywhere from 2 to 4%. Now, there are years when this does not happen, right? So this is not absolute, but this is just kind of on average in a typical scenario. May to October, stock market's up about 2.5%. 2.5%. But from November through April, the stock market is up on average 7.2%. So what that shows is that the fourth quarter of the year into the first and second quarter of the following year is where we make in the stock market, we make most of our gains, right? So the fourth quarter is very, very, very important, not only for retailers because of the Christmas season, but also for investors. As I said, the fourth quarter, the fourth quarter does about 4%. The market will go about 4% in the fourth quarter, the last 3 months of the year, and that Santa Claus rally from Christmas Day through the end of the year, about 1.5%. And then again, May through October, about 2.5% on the year. So the reason we're bringing this to your attention now is because we're going into that time. We're going to the fourth quarter of the year. Then we're going to go into the first and second quarter of next year. So, so this is the time of year when investors, as the stock investors, we usually get we achieve most of our gains. Now, all of us know what we've been going through for this past 8-9 months. Federal Reserve, COVID, war in Ukraine, yada yada. We talked about it, ad nauseum this whole year. So the reason why this is positive because we're going into what they call seasonality, and seasonality is just defined by where the market acts a certain way during different seasons of the year. Fourth quarter of the year, into the first and second quarter of next year, that particular season. So just say winter into maybe fall is the best time of the year for the stock market. We're going into that. However, I'm tempering everyone's enthusiasm by saying this is on average, this is typical. What we're going through right now with the Federal Reserve and all the stuff that's facing the market is not typical. So this may not happen this year. I'm not saying it is. We're just showing the data and information of what's typical. Now, shifting from that, we do not get a Fed. The Federal Reserve does not meet this month, but we do get a CPI report, the inflation report. We do get that this month. The Federal Reserve meets November and December. So we're going to have 2 more rate hikes this year. How much those rate hikes are going to be, we have no idea. The theory right now is that November will be 75 basis points or 0.75%, and then December will be 0.5%, which would then take the Fed funds rate, which is the rate all interest rates in the economy are based on, up to about 4%. And then banks add typically 3% on top of that for the prime rate. And then for the typical person who take out a loan anywhere, they add 3% more. So basically take that 4% Fed fund rate and just add 6 points to it. And that will be roughly kind of like what in a range, but roughly what our interest rates in the economy will be. So rates are going significantly higher by the end of the year. That's going to, as we know, cause havoc in the stock market, as it's been doing. But
it will affect the real estate market too.
Oh, it already has. Oh, it already has. Real estate is getting absolutely crushed. I talked about this in our meeting this week with the Panthers that the value of real estate in the United States dropped by the biggest amount in history of recording drops in real estate ever. This past, I think either last month or 2 months ago. And then refis are down like 20%. Mortgage applications are down like 30%. So the real estate market is getting absolutely crushed. Price of homes are coming down. So that's one area where the Fed is actually seeing a positive, in their mind, positive that it's slowing the housing market. And so the CPI report that's coming out next month will let us know. That comes out this month on the 13th. So it comes out next week. It'll let us know how inflation was for September. If that number is high, remember the month before it was 8.3%. Everyone's praying to the heavens above that it comes in with a 7 handle or in a 7% percentile range, because that'll show kind of a meaningful drop from 8.3 down at the sevens, which would be good. Federal Reserve maybe take their foot off the gas a little bit. We don't know. We'll have to see. But so I'm saying all that to say, we going into the fourth quarter and into the first and second quarter of next year is our best chance for some sort of good news over this year and over the next maybe 8 to 10 months. But we don't know what's going to happen because of the Federal Reserve. So we have to wait to see what's going to happen with inflation. But we just want to show everyone that that this time of the year is the time when most of us make our gains. And this also kind of comes back to the whole thing about, when you should be in the market, when you shouldn't be in the market. We're seeing, again, the end of the year in the first quarter of next year, on average, is where most of the gains are made, right? So if you pulled your money out last month and figured, you're just going to wait it out to see when the market, quote unquote, recovers, you'd miss out on possibly the best gains that the market typically gives us. So that's why we always say, even though it's painful, but if you want to go to cash or go to bonds, we get it. But you should always leave some money in the market for times like that we're coming up about now, which is our best opportunity for some sort of gains.
Yep. And so for anybody who's listening thinking, so what do I do with all this information? Check your account. So start there. If you're going into the end of the year and you haven't done some type of audit, if you will, or just revisiting your brokerage accounts, now is a good time to do it because you may not know what you have in your account. A lot of us have taken the mindset, we're just going to stick our head in the sand and just hope for the best when we pull our head out. Hope is not a strategy for success. So you really need to look at your portfolios, and we've given you all a lot of guidance. I mean, some of you all listen, some of you all just watch the videos, some of you all think, the market's still rigged. There's still the fact that when we did our hot seat, it was incredible to see the numbers that we uncovered for some of these stocks. I mean, we're talking over 1,000% return in the last 15 years. I mean, and that happened more than 3 or 4 times. We found stocks that had over 1,000% return over the last 10 years. So that essentially means it was roughly 100% return per year. That's incredible. So you really need to think about the long term, how many years do you have to stay in the market? Not how do you jump in, jump out because of fear. If you are that afraid of the market, there's a high probability that you are improperly allocated. So that means that your asset allocation does not coincide or does not match or align with your need to pay your mortgage, your need for groceries, because the money you have invested shouldn't, number one, be invested in the way that it causes you to lose sleep. 2, it shouldn't be so much of your money invested that if you were to lose a good chunk of it, you're destitute. So definitely check your asset allocation, and going into the fourth quarter is a great time to do it. And if you want to know what stocks, we've been suggesting, you can log into the platform and you can see our list of stocks we've been picking since roughly 2020. And many of the stocks we picked in 2020 were stocks Leon and I have been following for the last 10 years or more. So although we may have announced them in 2020, many of those stocks we've been tracking for over 12 years or so. So with that,
hey, bro, real quick, can you put your video on the screen, or because I'm just looking at me? I'm just looking straight at me because you're talking. I don't know if you can add it to it, or you can take the thing down now. Yeah.
All right. Yep. There you go. So just again, check your accounts. This is a summary. So Leon, did I miss anything?
No, that was really it. Just so again, just to recap, we're going to the fourth quarter, and also we're going to what's called earnings season too. So this is companies going to be reporting their earnings for the third quarter. They report them in the fourth quarter about the previous quarter. So that could bring a bit of volatility too. That's another important point because one thing investors, the Wall Street is looking at right now is, of course, what the Fed's doing, but investors are also looking at it to see, okay, they're saying, okay, how are earnings holding? How are companies doing in this economy, where you have all these factors, COVID, the Fed, the war in Russia. How are companies' earnings holding up? So we'll get some answers going to this fourth quarter with this earnings season that will affect the market, because if earnings are down and they're bad, a lot of these company stocks will suffer. If earnings are good and things are kind of stable, the market may not act as bad, and we could sort of stabilize, especially if inflation comes in not as bad as expected. So also know that this is also earnings season. So for the next 2 months, we'll be hearing earnings report coming out for most of the major companies and the S&P 500.
All right, so everybody, if you're looking for our stock picks, you'll be able to find them inside of the platform. You can go to iamembers.com, log in, and everyone knows where to go at this point. So you know where to go once you get in there. If you are not a member, you can go to iamembers.com and join. If you are interested in investing with the IAA Portfolio Panthers, reach out to myself or Leon. We are adding real estate to that portfolio pretty aggressively, both international and domestic. So if you want to be a part of it, we've already seen properties increase 100% that we've invested in less than 12 months. So, fingers crossed, as the domestic market gets crushed, there are many opportunities in the international market. And as the domestic market goes down, of course, those with cash positions or have enough to, purchase in cash, they can win pretty big. So with that being said, don't try to do it. Oh, go ahead.
One last thing, for members inside the membership community, make sure you check out the hot seat Saturday that's posted, that Brent was talking about earlier, where we found stocks that are up some are up over 8,000% over the last 10 or 15 years.
Yeah, I think the highest one was 9,372%.
Yeah, in like 10 years. One we found that's up 875% in just 3 years. And this is one of the most innovative companies to come to market in the last 20 years. And there's a reason that it's up 875% in the last 3 years. And the point I made when I posted was that we're not talking penny stocks. These are stocks that are multi-billion-dollar companies with hundreds of millions, or some of them close to billions in profits. So these are solid companies, because again, what we're doing now is we're actually putting hedge funds, pension funds, and major fund managers into the hot seat. We're actually going through their portfolios. So we're essentially taking advantage of the millions of dollars they spend on research. Brent and I are then doing research on their research, and then picking out the best one. So again, if you're inside the membership community, check out the hot seat that we just posted a few days ago. We found some gems.
All right. So with that being said, we just received a thank you. We'll end on that note. We're glad that you appreciate this. I mean, we do it for you all. So hopefully you use the information as well. We'll see you all again, not next week, but on the 19th. So we'll see you again on the 19th. Have a great day.